All right, all right. We are on both platforms. Still have a couple coming in through Zoom. I'm looking to transition next week. So I'm gonna try it. Now here's the deal. I'm not gonna like punish. I'm gonna try it, but then I'm gonna pop into Zoom and see if anybody's there. But we're gonna try no Zoom next week, starting Sunday, if possible. Starting Sunday, if possible. I will be sending out alerts and emails and making sure that everybody gets wind, that they have the link, the instructions to make the transition. And I think once we get that in place, it'll be a smoother process all around. I'm looking very much forward to it. Otherwise, welcome out, everyone, to the second to last. You blink, and 2 months have passed by. And 2 months have passed by, and we are almost done. Right? We are almost done with the Trading Options Foundations course. So, anyways, okay. I am absolutely trying, Stephen, to get everybody on that to make sure they have access. Okay, well, as it stands, then welcome to the Options Foundations 2.0. We have this is our last educational session. And then on Tuesday is our last wrap it up. We'll do a little bit of application. So we'll look at option Greeks from a portfolio standpoint. We'll answer any remaining questions, and we will move on and go from there. So, all right. What are we talking about today? We are talking about implied volatility and the options Greeks. Implied volatility, options Greeks. Okay, let's dive into it. Disclaimers, as always, remember that our subscription service is for education, illustrative purposes only. We are not advisors. We are not brokers. We don't give advice. We don't give guidance. Make sure that you are fully aware and understand every financial decision you make. Great. Let's get into the agenda. Hey, Press, good to see you. I love it. People just kind of pop in. We're building a great vibe there in Discord. I'm excited for that to be a part of what we do. Today, we're going to talk about, first and foremost, implied volatility in detail. Here's my hope. My hope is that as we go through this session today, as we go through each of these concepts, you're like, oh, yeah, I already know this. This makes sense. You've heard it multiple times repetitively. You're starting to connect these dots. I have this one at the end, but I really try to prime us for understanding the Greeks better by having ongoing discussions about the characteristics, the Greek characteristics of trades. Am I delta positive or delta negative? Am I theta positive or theta negative? What does it mean? What do I want? What do I not want? And that is hopefully putting together the building blocks of what you need to start assessing your options trading, not just from a trade by trade level, but from a overall portfolio level. We will talk specifically about implied volatility in detail. Then we're going to go through the Greeks one at a time. Delta, sensitivity to price changes. Gamma, how much does delta change as price goes up or down? Vega, how is your trade going to be sensitive to changes in implied volatility? If implied volatility gets bigger or smaller from where it is when you put the trade on. We're going to talk about the option strategy matrix. Sandy has posted this. I posted it one time as a picture. She grabbed it, archived it, She's posted it since then. It's floating around. If you ask nice, she'll probably post it again, even while I'm speaking. But we're going to talk about it. Like, how do we use that matrix, that nice little picture? Then we're going to discuss portfolio level Greeks. We'll talk about risk management considerations. We'll tie a bow on it. Get ready for a full set. I'm excited because when we're done here, we were going to go back and start back at trading foundations, but we changed our mind. Instead, we decided we're going to do some research. We're going to do some working sessions together. It's going to be a lot of fun. I'm excited for it. It's going to be great. Okay, so let's hit it. Let's hit it. Let me make sure I can see everybody's chat. Those of you on Zoom, I can see your chat as well. So please feel free to continue asking questions, making comments. Make sure this is understood. What we're doing today, look at Sandy, I already popped it up. What we're doing today is critical for long-term options trading. I don't care if you buy options, sell options, spread trade options, anything to do with options. Just understanding implied volatility and its impact, understanding the Greeks and how to assess how a trade is likely to behave as the underlying variables shift. It has to be there. This is what you're working towards if you're going to continue to be an options trader. If you get to this point and you're like, oh, I don't know, there's a lot here, it's overwhelming. Well, then I'll simply say, you're welcome that I helped you discover that before you got into trading options too much, before you discovered it the hard way. People who trade options discover this either because they join a phenomenal group like ours and we help you understand that, or the market teaches you painful lessons and you understand that. So here we are. Okay, let's hit it. Let's hit it. Did I skip one? There it is. A quick intro to implied volatility and option Greek. So what is implied volatility? We hear it all the time. But if you're like, define implied volatility, people are like, well, it's kind of like the put to call ratio, but it sort of represents. And you're like, look, if you're using words like kind of and sort of and defining, that tells me that you're not comfortable. Implied volatility is exactly that. It's a measurement. It's a standardized measurement of expectations. What are we expecting the volatility to do? Go up or down in the future based on what? Based on option pricing now relative to where we've seen the option pricing historically, meaning are options more or less expensive now than they've been. Why does that matter? Because people are more willing to pay for options when they have higher expectations that something is going to happen. If you don't think it's going to move very much, how much are you willing to pay for the option? Not very much. Again, I don't think it's going to move. And if nobody thinks it's going to move, nobody's buying options. So what is a market maker doing? He probably wants, if he wants buyers, he's going to do what? Make it cheaper. And then as people start to buy his options, they're buying. Eventually, he's going to be like, whoa, now I have too many buyers. And as people are buying the option, what is he doing? He's raising the price. They're buying it, raise the price until eventually he has too many buyers. And now he needs sellers. Well, as you raise the price, you're making it harder to want to buy and easier to want to sell. So that market maker manipulation of prices based on supply and demand is what is creating the fluff in the options. Implied volatility can only impact one aspect of an option's value, time value. Implied volatility going up or down has nothing to do with intrinsic value. That only has to do with the price of the stock going up or down. Implied volatility and its impact is all about the time value component. how much we have to pay for time. If people expect it's going to make a big move, well, then you can imagine that the reason we think that that expectation is there is because so many people have been buying options that the market makers just keep jacking the price up, and yet people just keep buying. And if they keep buying, where is the implied volatility going to go? Well, just like inflationary prices now. If people don't, the only way it comes down is if people stop buying. So that's what we're looking at. Essentially, it's looking at the next 30 days. And it's saying, what are our expectations over the next 30 days based on what options are trading for relative to what they've traded for in the past? And it just helps us understand how much of a move has the market already priced in. And that will become very helpful to us in determining what strategies we choose. A quick Greeks overview. Remember that our option Greeks, they are delta, gamma, theta, vega. The core are actually delta, theta, vega. Price, time, volatility. They represent key factors of options that help us understand option pricing and risk. What are the significance in options trading? Understanding implied volatility in the Greeks is paramount for us to do the right strategy at the right time. It influences decision making. It helps us to make sure that we account for what are we trying to be careful of, because that what are we trying to be careful of will change from market to market. What are the practical applications of implied volatility in option Greeks? If we master implied volatility in the Greeks, what happens is it helps us to make better and more strategic decisions to optimize our results, picking what spread, what strikes, how much risk. Am I more focused on being delta positive, or more focused on being theta positive, or more focused on being vega negative? On any given trade, we need to know what we wanted it to be and what is it. And we need to look at all three of those core variables, because somewhere in these discussions, there's always a pawn. You want more delta, you're going to sacrifice theta. You want more theta, you're going to be subject to vega. You want vega, right? And there's always these dependencies. So the question should always be, what's my priority, and have I achieved that? And if we don't have that, it's a problem. If we don't understand how to quantify that, it's a problem. So there we go. Okay. Moving on. Implied volatility. Implied volatility refers to the market's anticipation of future price fluctuations in the context of options trading. It's about implied volatility is 100% dependent upon supply and demand, right? How do we know more people think something is going to happen? Because they're more willing to pay. If they're more willing to pay, option prices go up. If they keep going up, then we see, oh, look at that. Relative to where we've been, look how high the volatility is. Obviously, we're going to look at some charts here. Well, let's just pause. Let's just do it now. Let's just pull up the SPY. Interesting day today as the SPY gapped down and then rallied all day and finished up. We still finished down for the day, or down relative to the prior day, but up relative to the open. The stochastic still shows it going higher. I'll tell you what, it's having a hard time. It's bumping its head at the 50-day moving average, right? But what do we have down here? We have implied volatility down here. So where is implied volatility now? Actually, it went from up here where it was a little elevated. Now you can see we still have just the last remnants of October when we had a correction. When we had a correction, we got up into the 20s. We haven't done that yet. So where is implied volatility? We actually determined on Tuesday that it was low enough. And we ended up doing a calendar spread instead of a butterfly spread for a trade. Anybody take that trade? That came out on the alerts. And you can see is it's doing okay. It's making some money. Nothing's happened, and it's making some money. That's not a bad kind of trade. Nothing's going on. In fact, the market pulled back a little bit. And what happened to our trade? Profiting. Yeah, right? That's why we need this stuff. For everything that's not a nice, stable, low volatility, trending market, for everything else. Now, how often do you think we have we're bullish more than we're bearish? But if you were to look at like how often are we actually in that type of environment? Maybe 30% of the time. There's a lot of sideways. So let's be ready, right? That's the point. That's the gist of what we're doing. Okay. So that's what we're talking about when we talk about implied volatility. Back here, when this market was trending up, look at that low vol, low vol, low vol, low vol, low vol, low vol, low vol. A little bit of elevation, but not much, low vol. And then over here, you can see a little different, feels a little different, looks a little different. So it's changed the dynamic to some extent, but that's why it's so important for us to see this, right? The implied volatility is such a critical component of forecasting, not just options and strategies, but actually market conditions. Okay. What's the role? Implied volatility directly impacts option premiums. Higher vol means more price, more expectation. If I think it's going to move bigger, I'm more willing to pay to buy the option, essentially, is the thought process here. Traders use implied volatility as a gauge for market expectations, helping assess risks and opportunities. The dynamic nature of implied volatility is important to recognize. It responds to changing market conditions. It's one of the first things that we look for, right? An expanding VIX, which then dictates two things to us. Number one, we think the market is changing. Number two, we need to be ready to do something about it, right? We need to be ready to be taking action. What action can we take? Okay. So let's go through these one at a time. Okay. And I'm going to quiz you as we go. I'm going to test. This is a test. Very informal quiz. Okay. Delta. This is critical thinking though. Like we want to be applying this in a critical thinking fashion. Delta represents how sensitive an option is relative to a change in the underlying asset. So what percentage of the underlying do we get? A delta of 0 to 1 indicates the expected change in price relative to a $1 change in the underlying asset's price. Now, that is a $1 bullish change in the underlying price, right? If it's a positive delta and the stock goes up, you gain at that rate. If the stock goes down, you lose at that rate. A positive delta, remember, means that we are bullish, and a negative delta means that we are bearish. And a neutral, delta neutral, means we expect the market to stay sideways. So it's a fraction. How does that fraction work? Well, if you look at this interpretation, a delta of 0.5, for example, implies the option's price is expected to change roughly half as much as the underlying. So if the stock goes up $1, my option goes up 50 cents. Stock goes up $1, I get 50 cents. Now you might be thinking, you only get half of it? Well, yeah, but I probably only paid like a tenth, a 15th. So I'm getting good leverage on that for sure. If I have, here's the first quiz. It's multiple choice. A is in the money. B is at the money. C is out of the money. Okay? In, at, out. A, B, C. What would you expect this option with a delta of 0.5 to be? A, in the money. B, at the money. C, out the money. First answer wins a prize. A, B, C. Oh, we got all kinds of answers. The answer and the winner is Steven. The answer is B, at the money. If I'm in the money, I expect a higher delta, 0.7, 0.8, right? The deeper in the money you go, the higher the delta gets, and the delta caps out at 1. Yes? If I go down, the farther out of the money you go, the less you get. So if you're way out of the money and you have a delta of 0.15, you're not expecting that option to go up very much. Well, it might not need to go up very much because you didn't pay very much for it. So that doesn't mean it's bad, right? I want you to notice that nowhere on my slide does it indicate quality. A delta of X is better than a delta of Y. It's not better, it's bigger. Bigger's not better here. Bigger's different here. Yes, you can have a bigger delta, but you're going to sacrifice something for that bigger delta. Or you can say, I'm willing to accept a smaller delta, but I get something in return. I'm sorry, right? So don't remember, these don't measure quality. They measure behavior, not quality. Nothing is good or bad here. It just simply says, if X, then Y. That's what this helps me understand. If the stock goes up $1, I get 50 cents. If I've been in the money option, I get 70. And you might think, oh, I should have gone for that. Well, wait a second. What if I only paid half as much and bought twice as many? Well, then if it goes up $1, I get $1 and somebody else only got 70 cents and we paid the same. So who's better? I would argue in that case, I am. It's never just like superficial. You got to be able to, that's why these things are important for us to get, so that we can kind of be like, oh, I see it already. I have a couple of responses like that. Oh, yeah, that makes sense. Okay, so that's delta. Some people use delta as probability. So for example, a delta of 0.5 which is at the money. If it's at the money, it's right where the stock is now. Well, theoretically, there's a 50-50 chance it goes up or down from there, right? 50-50, 50%. Now, if I'm already in the money, then there's a better chance it stays in the money. So a delta of 0.7 has a 70% chance of finishing in the money. Now, that's a rough estimate, and it changes from day to day anyway. So none of this should be dogmatic for us, where we're like, oh, well, my delta is 0.7, so rah, rah, rah. No. We just want to understand, how does it work? What does it mean? What are the implications? Great first quiz. Any questions about delta before I move on? What do we use it for? We tailor strategies. Are you bullish or bearish, first and foremost? And by how much? So then I understand, am I delta positive, delta neutral, delta negative, and how much delta do I want? Period. There it is. Moving on. This is exciting stuff. Gamma. Gamma. And you might think gamma risk sounds like a concept from the Incredible Hulk, but it actually means something. What does negative delta mean? So a positive delta means that if the stock goes up, I make money. The antithesis of that is if it goes down, I lose money, right? So a call option is a delta positive strategy. If I buy it and the stock goes up, I'm making money. The delta tells me how much I make for every dollar the stock moves. If it goes down, I lose at that rate. It's a two-edged sword. I gain at that rate, I lose at that rate, right? A negative delta is a bearish implication. So if I buy a put, I'm going to have a negative delta. That means I make money as the stock goes down. And the antithesis, meaning if the stock goes up, is where I would lose. And the delta tells me at what rate, right? Delta positive, bullish. Delta negative, bearish. That's the easiest way to think about it in those terms. What is the gamma? The gamma tells me, remember, my delta does not stay the same. If it's 0.3 out of the money and 0.5 at the money and 0.7 in the money, obviously it's a dynamic process that gets bigger and smaller, but it does it at increasing That's 100% right, Sandy. Gamma is delta's delta, right? Delta mathematically as a concept, the term delta literally in math means rate of change, right? So what is the rate of change of the option relative to the stock? Now we're talking about what is the rate of change of the delta relative to the stock moving. So if I have a delta of 0.5 and a gamma of 0.8, that means that if the stock goes up $1, my option gains 50 cents and my next delta is 58. 58. I get more. If the stock, in that same scenario, if the stock goes down $1, I lose 50 cents and my next delta is 42. Up and down, same way, right? Up and down, same way. Now, it always is the most sensitive at the money, around the money. If I go from deep in the money to deeper in the money, I might go from a 0.85 delta to a 0.87 delta. If I go from at the money to in the money, I might go from 0.5 to 0.7. Then it goes 0.78. Then it goes 0.82. Then it goes 0.85. It slows down, right? Everything kind of has its own dynamic functionality in that regard. Can you explain how gamma sensitivity changes near option expiration and how this impacts our risk management strategies, especially in fast-moving markets? Oh my God, what an amazing question. And the answer is yes. Not only can I, but you also have stumbled upon the concept that exists both in an Incredible Hulk movie and in options trading, and that is gamma risk. Gamma risk. What is happening? What does gamma risk tell us? As we get closer to expiration, 4 weeks, 3 weeks, 2 weeks, 1 week, we know that time expires at an increasing rate. We go slowly, 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 and then it starts to speed up and then it falls off a cliff. Well, falling off a cliff is the last week. So what is the fact that the time value is disappearing so fast doing? It's eliminating the cushion that time provides. So what that means is that what a $2 or $3 move early in the trade, you're like, ooh, yeah, I felt that a little bit, but I'm okay. A $2 or $3 move late in the trade, and you're like, my God, that hurt, right? It's more sensitive. So your gamma goes from a 0.05 to a 0.15. So $1, and you're like, holy crap, this thing is starting to just wallop me. So phenomenal question, much appreciated. But that's literally the definition of gamma risk. Gamma risk, gamma at the end of the life of an option in that last week, when time value is diminishing at an increasing rate, it makes the delta that much more sensitive to changes. And so, yeah, trades become unwieldy in that last week. We really have no interest for the most part of hanging out, right? I've seen trades that were 80-90% profitability that were just like credit options, and people are like, oh, I'm just gonna wait till the expiration and it'll expire worthless and I'll make all the money. And then the last day just like smashes them, and they're like, oh my God. So yeah, interesting. Gamma ray zapping my mind, right, press? Oh, I love it. If only people knew how exciting the option Greeks could be, they really would talk about it at parties, I think. Or maybe it's just us. Only at the Market Watch group Monday evening parties. So does watching gamma become more significant closer to expiration? 100%. If you are in that last week, you have to become increasingly vigilant to gamma and what gamma is doing, right? This is what I mean. Like, imagine this conversation early in your options. It's over your head, but you start to see just how important it is, because we've all probably had a situation in the last week of an option where things just sort of went crazy and you're like, what is going on here? And there's no good explanation. But the Hulk got stronger with gamma, not weaker. That's true. That is true. Oh, okay. A higher gamma suggests that delta is more sensitive to price changes, making it more responsive to shifts in the underlying asset. That's what we talk about when we talk about gamma risk. Gamma risk becomes increasingly an issue as time values decrease. Traders consider gamma when the responsiveness of their options towards market movements are going to influence their strategy adjustments. So impact is most significant as you get closer to expiration. That's 100% the point of it all. Early in a trade, we don't have to worry about gamma risk. I'm not going to be like, oh, I wonder what my gamma's doing in the last week. Oh, hell yes, right? Understanding gamma aids in managing risk by anticipating how delta may change and adapting positions accordingly. It is a matter of being proactive, right? Which is a professor move, rather than being reactive, which is, as we all know, the chimp making a move. That would be what makes day trading risk. It can be, absolutely, especially if day trading occurs closer to expiration. Okay. Ooh, that was a great gamma discussion. My goodness. Other option groups would hang their heads in shame as they watch the depth of our options discussions. Theta, T for time decay. What is the definition of theta? Also known as time decay. It quantifies the reductions in an option's value as time passes. Remember that each of these variables have their own unit of measurement, right? So delta, D for dollar, $1. Theta, T for time, 1 day of time, 1 day. V for Vega, volatility, 1%, 1% change there. Press. Oh, Press, my friend, I understand. You're in a big boat. There's a lot of really good traders in that boat with you that we have all paid more for some lessons than we would like to look back and think. But it's always nice when you feel like you've turned that corner, right? 100%. What do we need to know? We factor in theta when we're designing strategies, especially reliant on the erosion of option value over time. If we're thinking about time, if we're selling time, obviously, when it comes to buying and selling, that becomes a matter of cheapness. I like to buy things that are cheap, and I like to sell things that are expensive. That's just rules to live by in my mind. And that helps us understand what side of theta we either are willing to be on or want to be on. Awareness of theta is crucial for risk management. It helps us mitigate the impact of time decay on our option positions. You'll notice when we do things like calendars, butterflies, we're 2-3 weeks out. Hell yeah, let it expire. Roll off that cliff. We just manage it till it gets there and then let it cash in. When we buy options, we're going 5 weeks out, right? Like, oh, we're in it for 7 to 10 days. The time never really becomes an issue. Even subtly, how we do those things alters in strategy based on these types of variables and determinations. Okay. Any questions about T theta time? Let's move on to V Vega volatility. Vega, sensitivity to changes in IV, right? How much is that implied volatility measure? That's why I always keep it on a chart, because if implied volatility is low or high, I want to know what potential impact. Is it low at 20 and can get to 30, or is it low at 30 and can get to 50? Is it high at 30 and can drop to 20, or high at 50 it can drop to 30? Those things will have an impact. The definition of Vega measures an option sensitivity to changes in implied volatility, reflecting how much the option's price may fluctuate with shifts in market expectations. Meaning what? Meaning as people buy and sell options, If everybody's buying it, the market maker's charging more, and that's going to help if you're already a buyer. If everybody's selling it after you buy it, they're putting downward pressure on it. That's not good. That's volatility dropping, and you're a buyer. Those are how we want to be thinking about and understanding the implication for those things. Adapting to market conditions, traders use Vega to adapt strategies based on anticipated changes in market volatility, optimizing positions for different scenarios. Like what? Like right now, when we see that the VIX has spiked in a lot of areas, we're like, oh, we're going to do butterflies and broken wing butterflies. And then we look at the market and we're like, but wait a second, there was a sneaky little drop in the VIX that dropped it back below 16. And we're like, you know what? In this case, we actually think that we're going to do a Vega positive strategy rather than a Vega negative strategy. All deltas, thetas, and Vegas can be delta positive and negative. Delta positive means I'm bullish. Delta negative means I'm bearish. Theta positive means I make money from time, right? Time only ticks one way. I don't get to reverse time by being theta positive. Theta positive means that as time expires, it does so in my favor. Theta negative says you will lose time decay every day that you're in the trade. That's positive and negative theta. Positive and negative Vega tell us how we will gain or lose as market makers pump value in or out. If I'm Vega positive, I buy an option that's Vega positive. What do I want to happen? I would love for people to come in and buy that option so much that the market maker keeps charging more. He's pumping value in. Well, I'm already in it, so that's great for me. So if I'm Vega positive, I want Vega to go higher. That's going to help me. If I'm Vega positive, I buy a call option, and all of a sudden everybody starts selling those calls. The market maker is like, oh, geez, everybody's selling them. I'm going to lower the price. Well, that doesn't help me. So if I'm Vega positive and volatility comes out, that's going to hurt my trade. Now, flip-flop that. If I'm Vega negative, I want volatility to come. I want them to pump the value out. Right? When would I be Vega negative? When I do a spread trade, when I do a butterfly. If the applied volatility is high and it starts to bleed off. So just like we talked about back in October, when the vol was up in the 20s, if we have another correction here and we end up in the 20s, when we first come out, we don't want to buy expensive calls as the volatility bleeds off. When we first get into a bull market coming out of a correction, we need Vega negative strategies. We don't do Vega positive until the vol's all the way bled off and the volatility's low. Then we're like, okay, now we can buy options again. Otherwise, we're doing spread trades and broken wing butterflies. Those are all Vega negative strategies. So that's hopefully this is connecting some dots within the Greeks because, as I said, we're going to start thinking about them from a portfolio perspective. We can use volatility for hedging. Understanding Vega is essential for volatility hedging. We can manage risk by adjusting positions in response to fluctuations in implied volatility. Our calendar spread on the SPY. Here it is. What is the theta? Positive. We make $23 a day every day that we're in that trade, and every day gets a little better. Vega is positive, which means if the market drops and volatility rises, we're going to make money from that. We're actually delta negative, barely though, barely negative. What does that mean? It means that if it drops a little bit, we'll make money. Volatility goes up, we make money. As time passes, we make money. If you look at what we really want, we want this here. Right? We want this here. Let's go back to today. Here we are. Where are we? Boom, right here. Here we are. It goes up. We want it to go back down. If it goes down, we want it to go back up. The top of this purple is right where the volatility will be, or right where the delta is 0. You can see right here, it's actually a -1. We are right at the sweet spot. right? What's our Vega? 85. Our Vega is 85. What does that mean? That means that if this thing were to drop down and you think, oh, if it drops all the way to 494, we're going to be losing a little bit. No, we won't. Why? Because as this drops, remember what's happening? We're getting implied volatility. Implied volatility pumps value. This whole thing gets better. We don't expect implied volatility to drop while the market rises, though. That's what we mean when we say a Vega hedge. Love it. Beautiful trade. Beautiful trade. All right, here's our mix. So what does this all mean to us? Well, the first thing we need to do is we need to decide, are we in a bull market, a neutral market, or a bear market? Well, right now we're in a longer term bull market, but a shorter term neutral market, right? And what would we say the implied volatility is? Well, we said not low, although all of a sudden when we thought that, we looked at it and we said it was low. So when we did a trade on Tuesday, we said, wait, I'm more neutral, and meaning I think the market may go sideways, and we actually put ourselves in a low volatility situation. So what did we decide to do? A calendar spread. You'll notice that I followed the matrix on that. At first, I was thinking not low volatility. We're thinking butterfly or condor, but the problem was the vol dropped. If that vol's back up a little bit, now we're doing butterflies and condors again. So if I'm bullish and the volatility is low, I'm thinking what? I'm going to buy calls. I'm going to do out of the money bull call spreads. I'm going to do diagonal spreads. Why? Because these are going to be delta positive, Vega positive. They're also going to be, well, diagonal spreads maybe will be theta positive, but long calls and out of the money bull call spreads are actually theta negative. You're losing money from time. And you might be thinking, Scott, why? I don't want to lose money from time. Well, because in that case, time is cheap. I'm willing to lose money on time because I'm gonna hit some really nice trades. If that makes sense. If you're bullish, but it's not low implied volatility, what are we gonna do? At the money, bullish vertical spreads. We're gonna sell naked calls. I'm sorry, selling puts. Sell naked puts, covered calls. So we're going to do spread trade. We're going to do things that are what? Vega negative. Vega negative. So when would we be bullish with not low implied volatility? Coming out of a correction. Back in October, November. Wasn't low volatility for that first month. So if you bought options, it was working against you. This is going to help you. Now, a lot of people will show you bigger matrices than these. I don't really believe in mid volatility. It's either low or not low, in my opinion. Makes it easier. Make your life easier. Low, not low. Cheap, not cheap. And you can see what we have. If I'm neutral, I've got calendar spreads, butterflies, and condors. If I'm bullish, what do I have? I have long calls. I have short puts. I have spreads. And I have a covered call. Those are my bullish strategies. It's just a matter of low vol or higher vol. If I'm bearish, you'll notice there's a lot less. I have naked call on there, but I'm going to say no. No reason for that. Right? Buy puts, do some spreads. Those are our bear strategies. Is there a relationship between implied volatility and the VIX? That is the relationship, because the VIX is considered the gold standard formula utilized for assessing implied volatility. There's actually a white paper produced by the CBOE about the calculation. Now, most implied volatility calculations then replicate that on individual stocks, but the VIX is implied volatility of the S&P 500. It's literally looking at S&P 500 index options. The VIXN, VXN, is looking at NASDAQ options. The RVX is looking at Russell options. The VXD, is looking at Dow options. And all stocks have that same calculation applied. So the way the relationship works is this. Let me bring this up. So if you look at, this is the SPY, and you look down here, this is the VIX. If I type in the VIX, this picture is just going to transpose itself up top. What's down here literally is a representation of the VIX. So you can see it came down from high, sideways, starting to escalate. I go back to SPY and you look at what happened. It came down from a high, sideways, starting to escalate. But if I go to Apple, well, Apple also, so this implied volatility is essentially the VIX of Apple. The VIX we use as a market-based indicator because it's implied volatility of the S&P 500, right? So if I come in here and I go to SPX, that's the index, and I go to add simulated trade, these are the index options here. These are not SPY options. These, look how many there are, just so many. And look how expensive they are. And the strike prices, these are what institutions tend to trade. So when we look at the VIX, we're just looking at implied volatility of the S&P. So if you go in and you look at an individual stock and you look at the implied volatility, essentially you're looking at what is the equivalent of the VIX to the S&P. That's what this is to Apple. Implied volatility in VIX. VIX is implied volatility of the S&P 500 index. Ooh, we are dotting some I's and crossing some T's today. Boy, I'll tell you what. This is important stuff. But now you see why I always make sure I have this on my chart down here, right? Amazing. Fabulous. Okay. Portfolio level Greeks. We want to assess our Greeks at the position level. So in Thinkorswim, it's doing the math for me. I don't think I have enough set up for it right now. But if you look here, you have to go to the old layout. This is what the new layout looks like. The new layout doesn't show you the Greeks. So some of you might be like, mine doesn't look like that. This is the old layout. You got to go here and you go to the old layout. And here you have delta, gamma, theta, vega. Now I need to beta weight it. Beta weight it to what? To the SPY. That means that it's basically standardizing apples to apples, oranges to oranges. Because if I have a $10 stock, the delta there is not the same as a $500 stock. So what this is doing is it's saying, hey, let's use our SPY as the baseline, and then everything else goes around that. Oh my gosh, amazing press. Have fun at Joshua Tree. It's amazing that you're here before while you're doing this with while you're camping. Very cool, man. Have fun. Okay, so what this does is this tells me not what is my theta for the option, but what is my theta for the trade? What is my vega for the trade? And then when it does all of them, it tells me, hey, what is my position? So let's just use this as a quick example. My delta is minus 11. That means that my portfolio is neutral to maybe slightly bearish. Right? Does that make sense for market conditions? I would say yes. I'll be like, yeah, you know what? I think this market's kind of grinding sideways and may even pull back a little bit. Awesome. Theta is positive. Every day that goes by, this portfolio makes another 25 bucks. 25, 25, 25, 20. Right now, if the market drops, I get a volatility hedge. If the market rises, it'll hurt me the other side, right? However, I'm not too worried about it dropping, the volatility dropping. More worried about it rising than dropping. So I look at this and I think, yeah, I'm pretty well positioned. If somebody came in here and they saw that they had huge amounts of delta, that just means you have a bunch of bullish trades on, and you'd be like, wait, why do you have so much delta? This market's not that bullish. Or you might come in here, and if you had 6, 7 long options where you bought options, you'd come in here, you'd have minus 12 theta, minus 15 theta, and then you add it all up and you're like, oh my God, I'm losing $125 a day. This portfolio either performs or it starts punching me in the mouth on a daily basis. That's good information to know, I think. I can come in here and see, oh man, I have a huge positive Vega. If I have a huge positive Vega and I go look at the VIX and the VIX is in an elevated situation, I'd be like, whoa, if this volatility drops, it's going to hurt me significantly. So it helps me to identify risks that I might not see. This is a general's level perspective. Every trade needs to be evaluated on its own merit, but at some point you got to climb to the top of a hill, look down and look at the totality of your trades as they behave in market conditions together. Yes, they are all independent, but the totality of them together represents your portfolio. So you want to make sure that what that totality represents is in line with your market posture. I can't tell you how many times when I get to somebody's portfolio level Greeks in a coaching session, I'm like, oh, so you're strongly bullish, huh? And they're like, no. I'm like, yes, you are. Yes, you are. Your portfolio tells me you are. Right? They're like, what do you mean? Well, you have a lot of bullish delta. So you'll do great if the market goes up, but if this market pulls back, it's gonna hurt. You need to see that that's gonna happen. Or I'd be like, oh man, look at you, you're losing 150 a day in time. They're like, what? They don't even realize it. Yeah, eyes wide open. That's what the Greeks give us. Eyes wide open on what to expect. Yes, there's a lot of moving parts, but no, once we dive into it and break it down, it's not that much of a mystery anymore. We can handle it. We can make informed adjustments and decisions to our strategies based on changes in conditions as they come. Yeah, I mean, I feel like that's the way it should be. Okay. We want to, if possible, regularly assess delta, gamma, theta, vega, not just on individual, but in totality. It helps us to see where might we be at risk. Are we at risk for price going up or down? Are we losing too fast from time? Are we at risk of volatility shifting on us? Where's the risk? And I'll tell you what, eventually I've had it lead to trades where I'm like, oh my gosh, I need to add some bullish delta and reduce my Vega. Oh, okay, great. Bull put spread. Boom. I just put it on. On what, you might say? SPY. Put it on the market. It gives you bullish delta, gives you positive theta, gives you negative Vega. It brings balance to the portfolio. Awesome. Free trades, right? Free trades. Love it. What are the risk management considerations? Obviously, we always have to be aware of implied volatility. That's everything to us as options traders. That is the visual representation of supply and demand. How are options priced? I don't know if they're cheap or not cheap. I don't know how I want to trade them. Greeks in assessment. We want to make sure we utilize them to assess on an individual trade basis and on a portfolio basis. It's going to help you with position sizing, and it's going to help you with diversification strategies. Okay. And there it is. We lost press. He made it almost to the end. Congratulations to the rest of you. This is a lot, right? You can see why you might think, it would be really beneficial to go through that at the beginning. It won't make sense at the beginning, right? Unfortunately. There's nothing I can do. It won't make as much sense. That's why I try to talk about it as we go, prime the discussion. What is delta? What is theta? What is Vega? Over and over. And then we get here and we're like, okay, and we now really connect the dots and see what this picture's supposed to look like. I got to say, from the comments, it really felt like there were some connections. Let me know if not. I mean, this is a tough one, but we have more to go. We will do a working session. Any final Q&A from any options, but we'll do a Q&A. So, oh, you didn't, I thought I posted that. Okay. Thank you for flagging, Stephen. I'll put that up. Yes, let me know. Let me know. Are there any questions before we wrap it up for today? Well, as I said, pat yourself on the back. This is required, right? This is prerequisite for options traders. No questions. Thank you, Phil. Appreciate it. Thank you, Sandy. Trades held up with the rough market. Always love to see that. All right. Well, yeah, look, if you have like Delta specific or Greek specific questions, bring them on Tuesday. Bob, a delta is between zero. Bob said, I have deltas from minus 42 to 589. Those are trade level deltas. The inherent read of a delta is at the option level, which means you're doing it from an option chain. So the way a delta is going to work is it's always going to be between 0 and 1. So if I have a delta of 0.5, but I have 5 contracts, well, remember 0.5 first has to be multiplied by 100 for the 100 shares per contract, because Greeks on the option table level are per share. So the delta of 0.5 is per share. I need to multiply that by 100. Now it's 50 per contract. Then I multiply it by 5 contracts, and now I have a position delta of 250. And yes, that does become a dollar value. Now that position value says if the stock goes up $1, I make $250 on that position. If it goes down $1, I lose $250. So we start at the share level. That's what you would see on an option chain. Then you multiply that by 100 and it becomes an option Greek. Then you multiply it by the number of contracts and it becomes the position Greek. So there you go. 10 contract trade, right? So there you go. You got it right. That's a delta. If that was 10 contracts, that means that you bought, that means that it's a 59 delta. So I'd say slightly in the money. 10 slightly in the money contracts. Barely in the money though. Like at to slightly in. That's what I would say. Great question. I'm glad I could clarify that. Super important stuff. All right. Well, we made it to the top of the hour. It's good to see everybody. We will not be on tomorrow morning, right? Tomorrow morning will be a U session. I think I have to start it though, so I'm gonna handhold it. I don't think I'm gonna be able to jump in though. So if you guys want to do it, jump in, have a conversation. That's happening tomorrow morning. We will meet in the afternoon at 3:15 p.m. Eastern time for our weekly market wrap-up. We'll process this thing, put it to bed for the week, and move forward from here. Thanks, everybody. It's great to see you. Have a great rest of your night. And as always, happy trading.